Even if you're new to investing and saving, or even if you don't do it at all, you're probably familiar with the name Warren Buffett. The Berkshire Hathaway CEO and finance genius has decades of experience teaching Americans how to build their money by looking for value. This practice has not only been profitable for Berkshire stockholders, but it has also made Buffett one of the wealthiest persons on the planet. Even for those of us who aren't looking for a fortune, the Oracle of Omaha has some excellent advice, which he shared with CNBC. The simple trick for saving for retirement. The word trick is in quotation marks for a reason. It's not so much a trick as it is an alternative way of thinking. Buffett recommended savers to buy S&P 500 stock and keep doing so in the CNBC interview. That is the key to not only having a robust retirement fund but also having more wealth on hand to give down to your family, according to him. Keep buying it through thick and thin, he explained. Especially when you're going through thin. According to Buffett, it can be quite tempting to sell when the market sells and to buy when the market buys. However, doing so implies you are not receiving the best value for your money. When we see bad newspaper headlines, we say, well, maybe I should skip a year. Just keep purchasing it, he said. When you invest in the S&P 500, you are investing in the largest and greatest companies in the country. So, like Buffett, you must remain optimistic that these companies will recover. American business is going to do fine over time, so you know the investment universe is going to do very well. Buffett's track record demonstrates that he understands how to build wealth. Since purchasing his first stock in 1941, his net worth has grown from $5,000, about $108,000 in today's money, according to official data foundation, to more than $110 billion, according to Bloomberg. However, he claims that his success is due to much more than simply investing in growth stocks. The challenge isn't in selecting the appropriate company. Most people aren't equipped to do that, and I make mistakes on it all the time, he told CNBC. The trick is to buy all of the big companies through the S&P 500. And to do so on a consistent basis at a very low cost. Because investment costs do matter. Buffett recommends reading the fine print while investing for the future. It may appear that exceeding inflation with returns of 7% or higher is a good thing, but management costs can eat away at your retirement income, according to Buffett. If your returns are 7% or 8% and you pay 1% in fees, that makes a huge difference in how much money you'll have by retirement, he added. Even half the fees can pile up. A 0.50% yearly fee, for example, will eat $500 out of a $100,000 investment each year. That's $10,000 in fees over 20 years simply on the principal, not to mention how much of your investment returns will be eaten away over time. Fees are unavoidable in many cases. Even low-cost S&P 500 index funds charge them. So do your homework and you'll be able to compile a list of the most affordable solutions. Then, as Buffett suggests, continue to contribute for decades and you'll have plenty by the time you retire. I think it's the thing that makes sense practically every time, Buffett stated on CNBC. There are two methods that Buffett described here. One is buying and holding for the long run. The other method is dollar cost averaging. Investing the same amount on a regular basis means that you will buy more shares when the price is low, but fewer shares when the price is high. Both strategies are excellent ways to avoid market volatility over the long run. What investment strategies do you use for your retirement nest egg? Leave a comment down below. Take care and remember that your money matters.